Mauritian inflation had dropped to about 1.7% in June. That's from the 9% levels that it was at a year ago. So it's been a very good CPI outlook and inflation outlook. But those looking forward say by the end of the year we could be seeing inflation go upwards to 5%. What's going to inform that?
I think to a large extent we've already seen inflation starting to turn. The 1.7% that you're talking about is actually a 12-month trailing average. So if you look at just the year-on-year rate, it's already at 2.4%. So already we've seen inflation bottoming out around 0.1% on a year-on-year basis to the level of 2.4%. A large part of that increase has been due to a moderation of food disinflation, as well as some tick up in transport inflation as well. So going forward, I mean, the figures of 5% by the end of the year is slightly worse than we were expecting. We're currently expecting about 4.2% year on year. But I think the trend that everybody is seeing is that there seems to be some depreciation of the currency that the central bank seems to be trying to engineer, and that is going to lead to upward pressure on inflation. If on top of that we see oil prices remaining high or even returning to the sort of $80–90 a barrel level, then we're going to see that coming through as well.
All right, you talk about the depreciation of the currency, and we know that the rupee has been susceptible to events within the Eurozone economies, also like the shilling earlier on, tracking very much the euro because a lot of Mauritian products have a final destination, Europe, and the tourism sector, which is a huge component of the economy, relying heavily on European travelers. So your outlook for the rupee?
We think that the rupee is likely to depreciate. The central bank certainly is trying to engineer that. Over the last 14 days or so, we've seen the central bank coming into the market in a very overt intervention to try to buy foreign exchange, not just buying dollars, but also buying euros as well, because they are worried about, at least earlier on, they were worried about the strengthening of the dollar against the euro and the impact that was having on the Mauritian rupee against the euro. So the central bank certainly wants to see the currency depreciating on a trade-weighted basis. The interesting thing that has been happening over the past 6 months or so, in fact, since last year, the middle of last year, is that since the government introduced the fiscal stimulus and the central bank cut interest rate aggressively, we've seen actually the domestic economy rebounding as a result of that. But the problem has been the external demand, and we've seen that there has been a dichotomous pattern to growth in Mauritius. Domestic demand very strong, external demand very weak. As a result of that, the current account balance is weakening. So in order to try to moderate that weakening of the external balances, the central bank is trying to ensure that the currency does depreciate.
Right, in terms of the options available to the central bank, some are saying keep rates on hold, others are saying it's the end of that downward trend for the interest rate, it's time to go upwards now.
Probably they can wait till the end of the year, maybe early next year, before they start with the hiking cycle. Inflation, like I said, is 2.4%. It's likely to rise to, let's say, between 4 and 5% by the end of the year. The policy rate is already at 6.75%. So they can wait. Even if you look at T-bill rates, I mean, they're slightly above where inflation is. So there isn't really a pressing need for the central bank to start tightening monetary policy. But certainly, what they have to deal with is the imbalance in the external accounts.
All right, now in terms of us talking about tourism being a mainstay or a hallmark of this economy and susceptibility to what's happened in Europe, there is a view that events in Europe will have quite a bit of impact on GDP for Mauritius going forward, and will lead to a decline in GDP of about 0.4%. Modest growth at about 4.6%, with it being knocked further by events in Europe. In your assessment, how can Mauritius weather the storm, and is there likely to be this 0.4% impact caused by the European sovereign debt issues on the local economy?
Surprisingly, thus far, the problem has not been tourism, actually. It's been actually goods exports out of Mauritius. Tourism arrivals into Mauritius have actually been growing quite smartly since the middle of last year. And the likelihood is that you're going to see that trend more or less continue towards the end of this year. The problem has been goods exports out of Mauritius, and certainly the austerity measures being implemented in Europe are not going to help that. So in terms of trying to ensure that the economy does grow going further, I think what they're trying to do, which is to ensure that the trade-weighted weakness of the Mauritian rupee is certainly in the right direction. Inflation is certainly low, sufficiently low enough for them not to start to worry about the impact of a weakening currency on inflation domestically. But towards the end of the year, going into next year, if we don't see an improvement in goods exports out of the country, then they will start to focus more attention on inflation.